Hi everyone, welcome to today's video. So first and foremost, this is not a wallpaper. This is actually a natural background. I'm currently in Switzerland. No, I'm kidding. I'm in Manali. It is as beautiful as Switzerland. So highly recommend it that if you are planning a vacation, do come to Manali. Now over to today's video. So on today's video, I'm going to talk about a stock and I'm taking positions in this stock. The interesting thing about this stock is 3 data points. So first and foremost, this stock has given roughly 17% CAGR every single year for the last 15 years. Second key point, that its credit rating is at par with the US economy's credit rating and much better credit rating compared to many other developing nations and developed nations. Third and finally, the stock currently exists at 30% discount from its peak. So which stock am I talking about? The stock's name is, I'm not going to reveal it. Please watch the video for a couple of minutes at least. There is a reason why I'm not revealing the stock name right off the bat, because you will listen to it, you will go away and you will not understand the conceptual part of it. There are at least 2 points that I want you to remember as of now. So first and foremost, if you look at the entire macroeconomic situation, we are in a very volatile phase of the world's growth. What is happening is that there is US on one side of the equation and then there is Russia and China on the other side, and they are pulling the world apart. India becomes a party to this because India is a very important nation. But the problem is that if you look at India internally, everything looks good, but the world is so disorganized as of now. And if you keep on analyzing stocks just from India's perspective and only Indian stocks and do not even bother to learn about what is happening outside India, you will be in for a very rude shock. Something similar happened in 2008, that the 2008 financial crisis, it did not originate because of India. It originated in the US due to banking system faults in the US, subprime prices fault in the US, but India also got hit very badly. So the key lesson here is that even if you are an Indian stock investor and if you do not want to invest even one single rupee out of India, still you must understand some of the key developments that are happening outside India. Second key point, that many of you ask me that Akshat, we want to invest for the long term. We have some money lying around. We just want to invest and forget. So what type of companies we should be picking? Right now, such opportunities are quite massive in the US, and at least listen to 5 minutes of this video and I will clarify a lot of doubts for you. But let me give you a framework, and if you use this framework even in the Indian context, it will suffice. And you can pick some equities in the Indian market that might align with this framework and you can start buying them. Now, in order to have any asset that you are considering long-term investing, at least one of these characters should get met, and ideally more than one characteristic should get met. So first is the concept of capital preservation, that if you're investing in an asset class and it does not go down in value, that's a fairly good asset. A classic case in point would be gold, that hey, gold probably does not give massive returns. If you look at the yearly returns of gold, the gold returns have been very basic. It has not given more than 3 to 4% on an yearly basis over the last 100 years. But gold is great in terms of capital preservation, that if you put 100 rupees right now in gold, probably that 100 rupees will stay 100 rupees. But if you go and invest in a lot of stocks right now, your 100 rupee might even become 50. So that is the concept of capital preservation. The second concept is the capital growth, that for example, why are you investing? You are investing because if you are putting in 100 rupees, you are doing it with the hope that it at least becomes 110%, or at the very least it is able to beat fixed deposit returns. So that is the reason why you are making investments. So capital growth should also be there on that particular asset. Third and finally, the risk reward equation makes sense. Now, what is happening in the US stock market is that majority of the tech stocks have corrected. This includes big name like Apple, Amazon, Netflix, whatnot, right? So all these stocks have corrected. So this reduces your risk of buying these type of stocks right now. So in that context, today I'm going to talk about one such stock that is meeting all these 3 parameters, and the stock's name is Microsoft. So I'm going to speak about the Microsoft stock. I have not been an investor in Microsoft, but I'm building my positions now because I feel that the risk reward equation associated with this stock is great and it is meeting all these 3 parameters that are critical from a long-term investing viewpoint. So let us get the discussion started and let us understand the first point, which has to do with capital preservation or Microsoft's ability to pivot its business and survive in a highly volatile environment. So let me take you to the revenue mix of Microsoft over the last 10 years and look at the way today it has changed its business from 2012 to approximately 2021. In 2012, it used to have all these business lines and it used to make this mix of revenue from different sources. Now, over time, its business model has evolved. For example, right now, which is a cloud platform for Microsoft and it is ranked number 2 after Amazon, it has become a very promising avenue for Microsoft. A lot of revenues are coming from it. Going forward, they are focusing a lot on cloud computing and this industry is also growing. Microsoft genius has been that they have been able to pivot their business model, that's part A, and second and foremost, they are not dependent on just one income stream. They are very smart in terms of thinking 10 years ahead of the market and coming up with product suites, technologies, restructuring their R&D in such a way that they are always ahead of the curve. This ability to preserve their company, this ability to preserve their revenue stream, this ability to innovate and become a market leader quickly in certain spaces, this proves the point that Microsoft is a very stable company which is likely to survive even in the next 20 years. A related point through this chart is fairly simple, that they have not only been able to restructure their businesses as the time has turned, they are also able to consistently grow revenues and profits for their company. All the growth that Microsoft is exhibiting, that is profitable, sustainable growth. That is the key message, key point, and many of the startups can learn so many things from Microsoft. Now, this is just not my viewpoint. So there are 3 major agencies that give out credit ratings. And if I just take you to that chart, that S&P, which is Standards & Poor, which is one of the foremost rating agency, it has given a stable outlook to Microsoft. Fitch again has given a AAA rating. Moody's, which is again a very respectable credit rating agency, it again has given a AAA rating. Getting stable ratings from 3 of the most prominent rating agencies in a volatile environment, that proves the strength of Microsoft. Now, with this discussion out of the way, that is Microsoft likely to survive in the next 15-20 years, for which the likelihood seems very, very high. Let us structure our conversation on point number 2, that does Microsoft have the ability to grow its revenues? So let us look at the historic data here, and you will be surprised to learn if you do a comparison with the most diversified index, which is Vanguard 500 index, and compare it with Microsoft. If you take a look at 1-year return, it has given an average return of 33. If you take a look at 3-year, it has given 26%. If you pick anything, even the last 15 years, the returns have been close to 17%, which has beaten the index quite substantially. So the point is that history tells us that Microsoft has very clean management, it has ability to innovate, it has consistent ability to generate profits, revenues, and become a market leader. And even the stock market believes that Microsoft is a very good company to hold. But now we will get into the debate that, Akshat, you know what, all the tech stocks, especially the US tech stocks, they have been crushed. They were overvalued, they were overinflated, PE was high, etc., etc. So therefore, Microsoft stock also got crushed. The answer is yes, that the Microsoft stock did get crushed, but that does not mean that the business is bad. If you take a look at its latest result, it has shown growth on every single vertical from which it is making money. This is not a Microsoft specific problem. The business has not suffered at all. It is that the market itself has gotten shrunk, and as a result, Microsoft has become a collateral damage. There is nothing wrong with the business per se. If you take a look at margins, the margins are very much intact. If you look at operating income, that has grown. If you take a look at net income, it has grown. So there has been no problem with Microsoft per se. It is just that the total supply of money that is getting crushed due to inflationary concerns and bunch of other issues. And as a result, Microsoft has become a collateral damage. The more these type of businesses fall, the more you should be investing. This is not an investment advice. You should do your own due diligence. I'm just simply telling you what I'm going to do. Now let's run Microsoft through the third part of our long-term investment framework, which is analyzing the risk-reward equation. So let us first analyze where we are standing in terms of prices when it comes to Microsoft. And here is a very interesting chart for you. If you check from its peak, Microsoft has fallen by roughly 30% from its peak. This is a fairly large fall for a company of Microsoft's stature. Your obvious argument would be that, Akshat, you know what, PE were very, very high. I had done a tweet separately on PE ratios that people tend to believe and judge everything with a simple parameter called as price to earning. It is not a right matrix to judge a lot of things because in the PE ratio, the price, this P indicates price. No one can predict the price because these days the prices are being manipulated by the money supply that is existing. If Feds end up creating a lot more money, then the prices will fluctuate quite a lot. If Feds decide to increase the interest rate and pull out the money from the economy, then the prices of everything is going to get crushed. The second key part of this equation has to do with E, earnings. Earnings in simple terms means that, hey, if this is Microsoft, now at what rate or what velocity is the money flowing through Microsoft stock? No one again can predict the velocity of this money. So this entire PE ratio is not a very useful matrix when it comes to making decisions these days, especially around growth stocks. So please do not take PE as a holy grail in terms of making your investments. You will never be able to make concrete decisions based on PE. But contextualizing this from Microsoft's case, is the PE overvalued, undervalued? We don't know, because PE can be dramatically moved. The next time Feds print more money, I can write and give it to you that something like Microsoft is going to give impressive gains again. So if we are trying to ascertain that is Microsoft available at a good price, my answer would be a yes to that. Now let's analyze the second and the last part of this framework, which has to do with growth potential. Because when you are computing the risk reward equation, you have tried to compute the risk part of it by looking at the price part of it. Now reward can be simply ascertained by looking at what the growth avenues of the company would be. This is a very important aspect because the prices of the stock are driven by the future of the stock or the future earning, future growth potential, future profit margins. So therefore, if you're a long-term investor, you must understand that where this growth in Microsoft stock is going to come from. So there are three key avenues through which Microsoft will continue to make money or will make money in the future. The first and foremost is its cloud business. Now here is a very quick chart for you which shows why a lot of companies are investing so much money in amping up their cloud-based infrastructure, because the total addressable market size for cloud is very, very large. A lot of small firms are getting started. They need cloud-based support. Large firms are migrating towards cloud-based software services. So the point is that this public cloud total addressable market size is only going to grow with time. This is a sunrise industry. There is a reason why companies like Amazon and Microsoft are fighting a battle here. Is Microsoft getting beaten badly by Amazon on cloud? The answer is somewhat yes, that yes, Amazon is the number one player when it comes to cloud. But the type of services that Amazon cloud provides vis-a-vis the Microsoft cloud / Azure provide, those are slightly different. So as we go from A to B, both Microsoft and Amazon will cater to different set of audiences and offer different functionalities via their clouds. And here are some quick numbers regarding the Q1 performance of Microsoft Cloud Services, that its sales grew by 32% with an annual run rate of $94 billion. This is like crazy amount of business that they are doing through cloud, despite being the number 2 player in the industry. Now the second reason for growth for Microsoft stock in the future would be its metaverse business. Now this has got nothing to do with cryptocurrency, so please don't drop off. What type of metaverse is Microsoft trying to build? It is trying to build an office-based metaverse. What is an office-based metaverse? So right now, imagine yourself to be working from home. You do Zoom meetings. You probably like it because you can go to Zoom meetings wearing your pajamas and turning off your camera during mid-meeting and enjoying like watching my videos on YouTube on a parallel screen, whatnot. So the bottom line is that this work from home economy is useful, no doubt. It is useful for people working from home vis-a-vis the corporates who do not have to run physical offices at scale. It's useful for both, but there is a problem with this work from home economy. The problem is that this environment of work from home is not immersive enough. So Microsoft, through its metaverse, what it is trying to do is that it is trying to build more immersive work from home type of an environment where you can collaborate with your colleagues, where you can use Microsoft oriented tools and productivity suites to enhance your productivity for office work. So that is a high level understanding. So the specific set of products that Microsoft will release, we will have to see it with time. But to cut the long story short, this is an avenue that Microsoft is very clearly exploring. They have already existing moat in terms of offering productivity oriented tools, and they can definitely build this layer of innovation and benefit from it immensely. Why am I saying immensely? Because if you take a look at some of the research reports which talk about metaverses, it will become a $400 billion industry by 2028. So the bounty or the prize to be won in this industry is huge, and Microsoft is already leading that space when it comes to building an office-based metaverse. Now, the third and final reason for Microsoft growth will come from its existing set of products. Now, just to give you a couple of examples, right now, Microsoft is available on over 1 billion computers in the world, and still it is growing at a rate of 12% to 25% per year. LinkedIn, which is one of the businesses that Microsoft has acquired, it is growing at a rate of 35% per year. LinkedIn was a poorly monetized platform, but now Microsoft has started to figure out avenues as to how it can monetize LinkedIn. You might have started seeing some ads. They have started running creator accelerator programs. They have never invited me. I don't know why. But yes, they were very kind to give me an award this year on LinkedIn for being one of the top creators. I was also on their podcast. The reason why I'm telling you these points is that they are really trying to engage creators now. And going forward, LinkedIn is going to monetize itself really, really well. So that becomes another channel for revenue growth for a company like Microsoft. So with all these positive sentiments, you will say that Akshat, I'm selling my house and I'm going to buy Microsoft tomorrow. Please do not do this. Please understand the 4 risks with Microsoft stock. So first and foremost risk that Microsoft runs is the margin decline risk. The reason for that is fairly simple, that as any technology matures, the margins keep on going down because more and more competition enters the market. A classic case in point can be the mobile phone technology, that when mobile phones initially started, they were very expensive. When computers earlier started, the cost was very high. The cost of production was very high, but probably the margins were higher. Over time, as more and more players entered these spaces, the margins kept on getting chipped away. And now we have reached a stage that if you are buying a smartphone which costs less than 5,000 rupees, the margin for that company has come down to almost less than 3%. So that is the world we are living in, that as technology matures, the margins get shrinked, and margins are getting shrinked for a company like Microsoft also when it comes to its software related products. So this is the first key risk that they run. The second key risk is the acquisition risk. So acquisition simply means that Microsoft is going and acquiring a set of companies, set of businesses for accelerating its growth. Now, many of these are being blocked by regulators. But meanwhile, what happens is that there is a lot of hawa that is spread in the market that, Microsoft is going to go and acquire this particular company, and the stock price has a run up, and that gets reflected in the stock sentiment and price. But when the acquisition does not get through, it kind of hurts the Microsoft stock. Now, let me talk about that case by using the example of Activision, which is one of the top gaming companies in the world. Microsoft recently made a bid to acquire it, and that acquisition is likely to go through in 2023. There has been a lot of bullish sentiment in Microsoft stock because of this recent acquisition. Now, if you read the commentary of US Federal Trade Commission, they are reviewing that particular deal and they are trying to determine whether the takeover would give Xbox an unfair competitive advantage. So if they find that, this deal is probably not right for the market, they might unwind or nullify that acquisition. Now, again, the Microsoft stock will get hurt. Third risk that Microsoft is witnessing right now is the talent acquisition risk or talent acquisition war. This is a war that is going on at almost every major tech firm, Apple, Amazon, Netflix, Google, whatnot, right? So this is a talent risk simply because of the fact that all these companies, in order to stay relevant, what do they need to do? They need to focus on research and development, come out with really interesting products, and for that they need good workers. And if they are not able to retain the talent, then it becomes a problem. A related question that you might have is that, Akshat, who would not want to work with Microsoft? A lot of reasons, right? In fact, I personally know a lot of software developers who started out at Microsoft, but they migrated to working with Amazon because Microsoft was not allowing them to build their own YouTube channels and a bunch of other different things. So these type of small policies can also impact the talent war, can hurt companies like Microsoft in the long run. Now comes the final risk, which is the innovation risk. And I feel that this is the biggest threat for a company like Microsoft or Apple or Amazon. Web 3.0 ecosystem is already here, whether we like blockchain cryptocurrencies or not. Web 3 ecosystem is getting a lot of money still, despite the markets getting crushed, despite unicorns getting crushed. Web 3.0 ecosystem is still getting crazy amount of money. It's only a matter of time that a lot of Web 2.0 ecosystems are going to get converted to Web 3.0 ecosystem. In case you are wondering what Web 3.0 is, it simply means the advanced version of the internet, which is powered by blockchain and cryptocurrency, so to say. And it is much more immersive in nature. An example would be Microsoft trying out the metaverse space, but a lot of competition is already there in Web 3.0 ecosystem. It is only a matter of time that existing FAANG companies are going to get replaced by Web 3.0 projects in the next 10 years. So this is a change that is already underway and it will only accelerate with time. And it remains to be seen that how do companies like Microsoft will rise up to this new challenge. But I hope you enjoyed the video. You understood the pros and cons. Let me know in the comment box that are you going to invest in a company like Microsoft? Are you going to wait or are you not going to invest at all? So I would love to read your commentary and thank you so much for watching this video. I will see you the next time.